Vonovia stock is on sale right now. Let me show you what I mean. Just by taking a quick glance at the Google fact sheet here, we see a massive loss. But where is this loss actually coming from? We will explore this together and find the criminal in the drama and see if the stock price really should be as depressed as it is. Just looking at the 1 year stock performance, we see that it's down by about 50%, although some smaller European players are down by more than 80%, so the company is staying quite strong. This could be a result of a stronger balance sheet than competitors. It could be a result of good sort of margin of safety in the cash flows, or it could be a valuation on the current investment assets to current market cap. 13 billion today, and we can take a look at the balance sheet and compare that. But let's just get right into this interim statement and find out for you guys. There's a lot of interesting talk about development of properties and strategies in the beginning, but we will just skip all that. We will skip the sort of key numbers that the company themselves highlight. I like to look at that for myself and decide what I like and don't like. Starting off, we will look at results from operations. Taking a look here, we see the main point, 580 million from adjusted EBITDA from rentals, so earnings before interest, tax, depreciation, amortization. A big win for the company, a bigger win than last quarter of 2022 here. But we can see some smaller results for the other groups, divisions as well. I will not talk about them as they're not the majority of the business. You can pause and read for yourself. Just looking at the total number here, the adjusted EBITDA total, we can see 657 million, and then they take into account different interest expenses and things like this. But let's take a closer look at that. Let's highlight that for you guys to provide maximum value. And if you think this video provides value, considering doing a thumbs up so I know that you guys enjoy this type of content, or dislike if you don't think it provides value. Alright, so interest expenses, this is the financial part that is subtracted from operations. We see that it's become a lot more expensive. Interests were 60 million here for the first quarter of 2022, and now with the higher interest rates, it's almost 200 million. A big jump, very scary for investors. If interests go higher, it will continue to get more expensive. But remember, compare this number to EBITDA from the operations side, and you will see that there's quite a lot of margin, quite a lot of cash to bite through, so to say, to get to losing money for this company. So they're doing quite alright in that sense. But remember those numbers in the beginning. Remember the huge loss. Oh, it looked so scary. Let's take a look at what actually happened in this case. And to do that, we will have to look at the income statement, or consolidated income statement. We have that right here, the bottom of it. Oof, look at that. Loss, profit for the period. Boom. So this is billions. Losses in the billions, 2 billions. Wow. Not looking good for the company. How come? Well, we see that the big number here is, I will highlight it for you guys on screen. Net income from fair value adjustments of investment properties. So this means that on paper these properties are worth a lot less right now, and the values have been adjusted down. But yeah, if I'm the CEO, CFO of this company and I'm adjusting down the value of the properties on paper, because of course they're selling for a lot less right now, yes, well, then this means that the business is doing a loss. I'm not paying actual tax, although I still get paid from renting out and all these kind of things, and cash flow is coming into the company. Well, on paper the company is losing money, it's not paying tax, and it's actually getting tax credits from this. And also, number two, what about property tax? Well, in a a lot of instances it will be determined as a derivative of the total value of the property. So if the property is worth a lot less, well, then they will pay less in property taxes as a result. So less money taken and given to government, and more money preserved and can be paid out to shareholders at a later state. So that's what's going on. That's the big criminal in the drama that I talked about in the beginning of the video. We made it come full circle, guys. All right, and regarding just the balance sheet, we can see that it's not super hot right now comparing total current assets here of the 5 billion. We see the big post here, of course, investment properties. Remember in the beginning, looking at market cap of this company, 13.95 billion. We compare this to the value of investment properties, 88 billion, almost 89. So yeah, they're undervalued in that sense, but remember, interest rates are going up. It's scary. We see total current assets here of only about 5 billion. They have some inventories, they have some other stuff, cash and cash equivalents here, most important one. And just comparing that to liabilities here, we see total current liabilities of 5.9 billion. All right, that balance sheet is actually looking very good. That's one big reason clearly as to why the stock price haven't been completely punished as other European property companies have. Total current liabilities, yeah, that's a good ratio for sure. I have looked at some companies where short-term liabilities have been quite a lot larger than current assets, but refinancing this is not going to be a problem from the banks, I don't think. Also, given the size of the company, even makes it safer. So in my opinion, this is just a undervalued company right now. It's on sale basically. That's my opinion. Let me know what you guys think in the comments below, and as always, hope you guys make a ton of money whatever investments you decide to make. Take care now. Bye bye.